Hey guys, how's it going? It's Andy from MagooInvesting. Happy Monday. For the past couple weeks, we've been seeing a lot of optimism about the overall stock market. Just this past week, we had a 6% overall gain for the stock market, which is a crazy week. As we're starting to see more news articles about different states opening up and countries kind of relaxing their restrictions, we're still looking pretty good for the overall stock market, even if you don't agree for the reasons why it's going up. So at this point, I am still very bullish on the stock market. As a result, in the past couple weeks, I've been making videos talking about some of the stocks I'm looking to buy going forward. And I've made a video talking about undervalued stocks, just the tech sector overall, and then I made a video about social media stocks. And from those videos, I've been seeing a lot of comments kind of asking why I'm picking a specific stock over the other. In this video, I want to talk about these 3-step criteria that I use for kind of picking a company while looking at its direct competitors. At this point, there's 2,800 stocks to invest in, split across 11 different sectors. So at this point, you're not going to be finding any of these unicorn stocks, something that is so unique that it doesn't have any direct competitors. Pretty much any company you look at is going to have a couple of direct competitors that you have to kind of consider if you're buying the best stock in that sector. I remember even very early on when I was starting investing with Robinhood, if you click on a stock and kind of scroll to the bottom, there would be a list of competitors that you could consider. And so even on the most basic of apps, you have a lot of different options. Just a couple weeks ago, I made a video talking about Starbucks and kind of explaining the main reasons why I was so bullish on it overall. And at the end of that video, I talked about Dunkin' Donuts, which is a direct competitor. And during that part in the video, I kind of talked about why I think Starbucks is a better investment, even though I love Dunkin' Donuts products significantly more than Starbucks. And so that may not have made a lot of sense. So in today's video, let's start breaking down the 3 reasons why I would pick a stock while considering their direct competitors. Before we get started, I gotta say that I'm not a licensed financial advisor, and everything you hear in this video is just my own opinion. And I'd love to hear what you guys have to say about these companies in the comment section down below. Also, if you've been enjoying this content, I'd really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. We're getting really close to 3,000 subscribers, and I thank you all for that. So the first and probably easiest way for me to determine which company I want to invest in is based off of personal preference. In my videos in the past, I've talked about my criteria that I look at before investing in any company. And the first one I look at is it has to be a company that I've used in the past and I trust. And the main reason behind that has been very apparent so far this year. And when you invest in companies that you trust, if the stock market falls, as we've seen with the incredible amount of volatility so far in 2020, when things fall, if you trust the company to recover and get back on its feet, you're less likely to be selling your investments at a loss. If you've ever held a company that you don't really understand what they do and things go poorly, maybe they have a bad earnings event or a news story comes out that pushes the stock down. If you don't have a lot of kind of confidence or faith in the company, you might sell at a loss, which is what we want to avoid on this channel. So when we look at the video game sector, I've been talking about how I've been invested in Activision Blizzard for probably around 9 months at this point. It's actually my best performing stock in my portfolio. And in that sector, I kind of think of the 2 main players as being Activision Blizzard, ticker symbol ATVI, and Electronic Arts, ticker symbol EA. And so when you look at these 2 companies, there's a lot of similarities. And if you don't really have a personal preference, it can be kind of hard to pick which one you want to invest in. When you compare these 2 companies based off of their annual returns, you can see that there's not really one that kind of pushes in the lead. We've had Activision Blizzard, which was the best performing stock so far this year. EA was better in 2019 and 2018, and then Activision was better in 2017. So when you look at that data, there's not really something that pushes you towards one company over the other. When you look at their revenue charts, there's a lot of similarities. I think EA definitely has a better looking chart, but there's nothing on Activision Blizzard that kind of stands out to me as being a deal breaker. When you look at PE ratio, which is a way that people determine how undervalued a company is compared to the overall sector, both of them have PE ratios of around 30. So you can't really get any sort of additional information from that number. When you look at long-term debt to equity, which is usually my deal breaker when I look at companies, both of these companies are very low on overall debt, and I think EA might actually have the best debt to equity ratio I've ever seen, sitting around 0.05. And so Activision is 0.25, which is very low compared to most of the stocks we've talked about on this channel, but neither of them are deal breakers. Both of them have very low long-term debt. They have very similar PE ratios, but how did I determine that I wanted to invest in Activision Blizzard over EA? And the main reason behind that is I've been playing video games for 15 years. And I've only seen good things with Activision Blizzard, and I can't say the same thing for EA. If anyone's been around the video game market for any amount of time, I feel like it's pretty common knowledge that EA is one of the most hated companies in this sector, and they have ruined plenty of video game franchises in the past. And you can't really say the same thing about Activision Blizzard. And so in this example, personal preference was the main reason that pushed me towards investing in Activision Blizzard over EA. Even if you look at the fundamentals, the returns that you've seen in the past, they're very similar companies. They all look fantastic on paper, but my personal preference was going towards ATVI, and that's the main reason why I took a position in this company. I think both of them have fantastic upside, But my confidence in ATVI makes it so that I could hold if things fell. It's my best performing stock right now, but that might not be the case a couple months from now. And that faith in that company is the main reason why I will probably be holding that for years to come. So I'd love to know what you guys think about Activision Blizzard and EA in the comment section down below. And next up, for the second reason, I want to talk about how the company has moved in the past couple years. And so in one of my last videos where I was talking about tech companies, I was specifically talking about the semiconductor company Intel. And so when you look at that sector, there's a lot of massive players. I usually think of Intel, AMD, and NVIDIA. These are all three companies that I can't really pick based off of personal preference. I've used all of their products and I feel fantastic about all of them, so I can't really pick a favorite based off of that first criteria. And so when that happens, the next thing I like looking at is kind of how the price has changed over time. I don't consider myself a value investor like Warren Buffett, but I prefer to invest in companies that I can get at a discount or maybe where it hasn't taken off fully. One of the examples I think of is when I invested in Tesla last summer. I bought in at around $195 and I sold at $230, which is a pretty decent return. But then hindsight is 2020, and when I look at the price movement so far, it's sitting at around $800 at this point. And so while I still love the company and the reasons why I invested in it at $200 are still valid at this point, I've missed out on the massive movement that we've seen in the past year. And so at that point, it's not as attractive to me. When you look at these three companies, Intel is currently trading for around $60 and it's flat on the year. AMD is trading for around $55 and it's up 20% year to date. And then finally, you look at NVIDIA, which is trading at $320 and is up a whopping 36% year to date. So you can kind of see the spread between these three companies. And if you're looking based off of a value perspective, Intel has the best option. And then when we go look at the charts, I've talked on this channel a lot that when things are going well in the overall economy, I expect companies to go up in value for my investments. And so I want to see overall stability during times of economic growth. And while we're at the end of the longest bull market in history, I want to see fantastic returns over the past. When I look at Intel's 5-year chart, it's up 90% during that time, which are the type of returns that we're looking for. And then when you compare them to something like AMD, which is up more than 2,300% in the past 5 years, you can kind of see where I'm a little worried about investing in a company that's moved up so fast. Just back in 2016, the company was trading for $5 and now it's $55. And so it has moved up significantly over the past 5 years compared to Intel, which is 90% over 5 years, which is fantastic. You would love to have that for your portfolio. But the 2,300% is kind of a red flag for me. And you can see similar things when you look at NVIDIA, which is up over 1,000% in the past 5 years. So these two companies have outperformed Intel this year. But when you're comparing the deal that you're getting with Intel, it's at a significantly better price when you compare them to the 5-year returns of these companies. So while all three of these companies are fantastic, based off of a value aspect, looking at how they've moved over the past 5 years is one of the main ways that I determine which stocks I want to invest in. If these companies fell out of the sky, maybe as the result of a recession, I could totally see myself investing in NVIDIA or AMD. But as we've kind of expected that a recession is going to come, I've talked on this channel about usually these companies that have shot up in the past couple of years are the first companies to give their gains back. And so if we get those companies at a discount, sure, I'll take a look at investing in them in the future. But as of right now, for a value perspective, I think Intel is significantly more undervalued compared to these other stocks. Another common way for people to compare stocks is by using the PE ratio. It's not something that you can really use on its own, but if you're comparing companies using this that are in the same sector, it's kind of a great way to determine if a company is kind of undervalued compared to the overall sector. When you look at these three stocks, NVIDIA has a PE ratio of 67, AMD has a PE ratio of 125, and Intel is sitting at around 11. So based off of that value perspective, you can see how much of a discount you're getting with Intel compared to these other two stocks. And so these are fantastic stocks to own overall. And I think the semiconductor sector has been doing the best out of a lot of these sectors that we've talked about on this channel. But at this point, I don't feel comfortable taking a position in NVIDIA and AMD, companies that have been up more than 1,000 and 2,000% in the past 5 years. Intel has had 90% returns, which is the overall stability that I'm looking for a long-term investment. It kind of worries me to invest in a company that's moved up so fast so far because the same thing could happen to the downside. So when I'm looking for stability, one of the main ways that I look at it is by comparing the 5-year returns and how it's been moving year to date to determine if I'm getting a good deal or if I'm starting to invest in a company that has a lot of risk associated with it. Let me know in the comment section down below what you think of AMD, NVIDIA, and Intel. All right, the third and final criteria that I look at for picking stocks is by looking at the fundamentals. So when I'm looking at companies, I don't exactly have a personal affinity towards one or the other. The main thing that I look at is fundamentals, because how a company is run on the inside is a great way to determine how they're likely going to be run in the future. So when I look at Verizon and AT&T, Verizon, ticker symbol VZ, and AT&T, ticker symbol T. These are two companies that are very similar for what they do. But when you start looking at the fundamentals, you can see the overall differences between them. Currently, Verizon is trading for $56 and is down 8% year to date. And then you look at AT&T, which is trading around $29 and is down 25% year to date. So if these are two companies that I feel very similarly towards for the how much I prefer them, and so if I'm getting AT&T at a better discount for that second criteria that I just talked about, it kind of pushes it in that favor. But when we start looking under the hood a little bit more, the fundamentals are definitely pushing me towards AT&T, and that's the main reason why it's actually part of my portfolio right now. So when you look at the dividends, Verizon has a solid dividend of around 4.4%. It has a payout ratio of around 50% and has 15 years of dividend growth. These are all things that if you looked at them on their own, they'd be fantastic. For a dividend stock, everything I see there is great. That payout ratio, if you guys forgot, is the percentage of the overall earnings that are paid to the shareholders in a dividend. And so I usually like to look below 65%. And when we get to AT&T, which has a dividend yield of over 7%, a payout ratio of 65%, but it has 35 years of dividend growth, that's kind of where you're seeing the upper ends of the payout ratio, where I feel like the dividend is still safe for AT&T, but it's getting towards the high end. And so when you're looking at the discount, the dividend, at this point it's pushing me towards AT&T. But the thing that made me really go towards AT&T is when we start looking at long-term debt. When you're looking at these two companies, it makes sense that they have a lot of long-term debt. They are constantly needing to expand their infrastructure. They have to start investing in 5G, which should be here relatively soon. And so it makes sense when you look at their books that they both have over $125 billion in debt. Currently, AT&T is sitting around $147 billion, while Verizon is at around $125. And so at this point, AT&T has more long-term debt. But when you put it into perspective with shareholder equity, which is probably my favorite way to determine the overall stability of the fundamentals of a company, is where I look at the debt-to-equity ratio. And you look at AT&T, the long-term debt is balanced out by shareholder equity perfectly, with a ratio of 0.75, meaning that they have more shareholder equity than they do long-term debt. But then when you go and look at Verizon, which has less long-term debt than AT&T, but it has not as much shareholder equity, where they have a debt-to-equity ratio of 2. And that 2 for a long-term debt-to-equity ratio is kind of a red flag for me. And at this point, the shareholder equity has been dropping a little bit, and that 2 for a ratio is really high, and that kind of alarms me. So at this point, the discount you're getting with AT&T, the better dividend, and the better long-term stability, in my opinion, by looking at the long-term debt-to-equity ratio, is the main reason why I was pushed towards investing in AT&T over something like Verizon. This is kind of a similar idea to when I talked about the airline stocks, where I kind of compared all of the different stocks you could invest in that sector. And the main reasons why I picked Delta over all the other ones is the fact that their fundamentals look so much better than everyone else's. They have less long-term debt. Their debt-to-equity ratio is pretty low compared to the overall sector. They have the highest margins, meaning that they're going to be the most efficient in turning revenue into net income. And so those are the main reasons why I was leaning towards Delta. I don't have an affinity towards one company over the other. They're all at a significant discount, but the fundamentals were the main reason why I was pushed towards Delta. And so these are the main 3 ways that I kind of determine which companies I want to invest in while considering their competition. The first one I look at is personal preference. We talked about Activision Blizzard compared to EA. Activision Blizzard is a company that I have grown up with, and I absolutely love it. EA kind of has a special hatred in my heart based off of some of the horrible things they've done to my favorite franchises. And so that's why I picked Activision Blizzard over something like EA. Then we went and looked at the kind of growth of the companies over the past couple years and their returns year to date. We want to see overall stability in the company. And so when I see Intel, it's up 90% over the past 5 years, those are the numbers I'm looking for. When I look at AMD and NVIDIA, up 1,000% and 2,000% in the past 5 years, that gets me a little bit worried. And so that's why I was leaning towards Intel over these other 2. And then finally, we talked about fundamentals. And I like looking at the fundamentals last because usually you see the most damning evidence against companies. And when I looked at the difference between AT&T and Verizon, we saw the benefits for the discount for AT&T, a better dividend in my opinion that's still relatively safe, and then the long-term debt was kind of the red flag that went off that pushed me towards AT&T over Verizon. So these are my 3 criteria that I look at for picking stocks, and I'd love to know what you guys look at to kind of determine which companies in a sector you want to invest in. You have 2,800 different stocks you can invest in, spread out across 11 or 12 sectors depending on who you talk to, and so you have so many different options out there, and I'd love to hear what your criteria is and what you thought about my 3 ideas. Thanks for watching this video, stay inside, and I'll see you in the next episode.